You don't need a finance degree to become a successful investor. You don't need to be rich. You don't need to be perfect. What you do need is to start. Because the truth is, the most successful investors didn't wait until they knew everything. They learned by doing. They stayed consistent, and they thought long term. And that's exactly what we're going to help you do today. In this beginner-friendly video, you'll learn how stocks actually work, how you make money from them, how to avoid beginner mistakes, and how to build your first portfolio the smart way. Let's break it down. But first, one important reminder: investing always comes with risk. So only invest money you can afford to lose, not your rent money, not your emergency fund. Be smart. Use common sense. Learn as you go. So, what is a stock really? A stock is just a small slice of ownership in a company. When you buy a share, you own a piece of that business. If the company does well, your piece becomes more valuable. Let's say you buy one share of Apple. You now own a tiny part of Apple. If Apple grows, so does your investment. How do you actually make money from stocks? There are two ways. First, price growth. You buy low, sell high. If you buy a stock for $100 and it rises to $130, that's a $30 profit. Second, dividends. Some companies share profits with shareholders. If you hold their stock, you get paid just for owning it. Now, let's talk volatility. Stocks go up and down. That's called volatility. And yes, it can feel scary, especially in the short term. But over the long term, those ups and downs usually even out. That's why long-term investing almost always beats short-term trading. And here's the part no one talks about: investing psychology. Most beginners lose money not because of bad stocks, but bad decisions. They panic when prices fall. They chase hype when prices rise. They let emotions take the wheel. But the best investors stay calm, consistent, and committed. Discipline beats emotion every time. Let's move on to one of the most important principles: diversification. You've heard it before. Don't put all your eggs in one basket. In investing, that means don't put all your money into one company or even one industry. True diversification means investing in different stocks, sectors, and markets. That collection of investments is called your portfolio. A diversified portfolio helps protect you when one part of the market drops. It balances your risk and builds long-term strength. Now, what about fees? Let's talk about something called brokerage commissions. Every time you buy or sell a stock, your platform usually charges a small fee. This is often referred to as a brokerage fee or trading commission. It could be a fixed amount or a percentage of your trade. It might seem small, but it adds up, especially if you trade often. So, compare platforms. As a beginner, you want low fees, simple tools, and support that makes it easy to learn. And now, a quick reality check. Just because a stock did well in the past doesn't mean it will keep doing well. Past performance is not a guarantee of future returns. That's why we invest regularly. We stay diversified. We stay patient. So, how do you actually get started? Here's a simple 3-step plan. Step 1. Choose a brokerage platform with low fees and beginner-friendly tools. Step 2. Start with strong companies or index funds that you understand. Step 3. Invest a small amount each month. Automate it, make it a habit. You don't need to be perfect. You just need to be consistent. Let's wrap this up. Investing doesn't have to be complex. It doesn't have to feel overwhelming. And you definitely don't need to be rich to get started. All you need is to take the first step and stick with it. Start small, keep learning, think long term. This is Growth Minded. Please drop a like, share, and subscribe for more content like this.